It's not so easy to just say, hey, what's my rate? Like, what rate can you offer me?
Hi, everyone, and welcome to another episode of Hello Haymarket. I'm your host, Daniel Nice, and today we have Coleman Bales. Coleman, thank you so much for joining us yet again.
Thanks for having me.
I gotta say, you probably have the record for the most appearances on this podcast. For some reason, we like you.
It's an honor.
Coleman, the reason we wanted to bring you in today is because you gave a presentation at our team meeting, and that presentation had several changes in the lending world that I think everyone needs to know about. Really, without further ado, do you want to kind of get us started on the highlights of what we're going to talk about today?
Yeah, so absolutely. So like you said, there's been some changes in the lending world. All three of the most common loan products out there, your conventional loans, FHA loans, and your VA loans. There's been little tweaks in the pricing of all three of those products, and that's sort of changing what people might qualify for what program or what program might be the best for people in certain situations. So it's just changing things around a little bit, and it's worth considering for everybody that's looking at buying a home these days.
Now, he's got a visual that he brought to his presentation for the team earlier this week, and we're going to link that up. For those of you who are audio listeners, we'll try to give you a description of what it is that we're looking at here. So Coleman, what are we looking at? What does this first page look like?
Yeah, absolutely. So the first and foremost, we're going to talk about the most common loan product out there, your conventional loan. What's happening with conventional loans is the pricing system, the grid of what your credit score is and how much you're putting down and what rate that translates to. Those relationships are changing a little bit. For better or for worse, they're scrutinizing credit a little bit more heavily. So that's one thing we'll talk about.
So on the left-hand side of this matrix, I'm seeing the different gradations of credit score, which is a lot more finely graded, a lot more different categories now than there used to be. Mm-hmm. And then on the top, as we look across the table, we're seeing the different loan to value. The thing that stood out to me was comparing the old way versus the new way for credit score. So talk about that.
Absolutely. So basically the way that it works is before the top tier of credit score, with regards to conventional loan pricing at least, was a 740 credit score. So if you had a 741, you might as well have an 800 credit score. That's the best you can get. You're getting the best interest rates available. That's been changed to now at the top tier is 780. A significant difference, and there's two brackets. 780 and above is top tier now. There's a bracket for 760 to 779, and then there's a bracket from 740 to 759. So credit's being scrutinized a little bit more heavily. Not only is that impacting those people between 740 and 780, but it also has lingering impacts on people a little bit lower than that as well.
Yeah. So let me ask you a question then. Let's make this concrete for some folks, right? Mm-hmm. A typical example that I see a lot of people do is that they will be doing like a 5% down conventional loan, right? Mm-hmm. It's a fairly common scenario that at least I run into. Let's say this person has an 800 score, mm-hmm. right? Can you tell us what the difference would have been an 800 score before versus an 800 score now at 95%?
Yeah, absolutely. So basically the idea is interest rates are priced differently depending on how much money you put down. And as a general rule of thumb, it's supposed to be, risk-based pricing. So the less risky, the lower interest rate you're going to get. The way that a bank looks at a big down payment is that it's less risky for them to lend you the money since you have skin in the game. So before, say you're willing to put like 40% down, that's going to get you your best rate possible. If you put a little bit less than 40% down, like 30%, you might pay an extra quarter discount point. Just to explain what a discount point is, say that I could offer you, for example, I don't know, I'll just call it a 7% rate about what lenders are offering these days. With that rate, if you wanted to go lower than 7%, you can pay an extra fee called discount points. And one discount point is equal to 1% of the loan amount, but you can actually pay fractions of a discount point. The important takeaway is that if you want to pay a little bit extra, you can get a lower rate. If you put 40% down, say you're at 7% for 0 points, and again, this is not real rate quotes at all. I'm just making these up for the purposes of our podcast.
Yeah.
With 40% down, you're at 7% and 0 points. If you bring that down to a 30% down payment, you're still at a 7% interest rate, but you're now paying a fourth of one discount point for that same rate.
Yeah.
Okay, so it's just a little bit more expensive to have the same rate. Maybe I could give you 7.125 and mm-hmm. do it for 0 discount points, but the pricing overall is just a little bit more expensive. Bring that up to, say you only want to put 20% down, it's going to be a little bit more expensive, even more so a little bit more expensive.
Yeah.
A lot of people think that you need to put 20% down to get the best pricing. Mm-hmm. You used to be more like 40% to get the best pricing, but people would be surprised to find that If they put 20% down, the rate might be a little bit higher than if they put 15% down. And the reason why that is again, it's risk-based pricing, and the bank is assessing how risky it is to lend you this money. And any time that you put less than 20% down with a conventional loan, you're required to pay something called mortgage insurance. Now, mortgage insurance is not like homeowners insurance, where if your house burns down, you can file a claim for your own benefit. It's for the benefit of the banks, and they require it on loans where you're putting less than 20% down because, again, less skin in the game. That's more of a risky proposition for the bank. And so that insurance policy that the bank is getting, it would help get them paid back if you stop paying your loan. So the bank knows, even worst case, I know this person isn't bringing 20% down, they're bringing 15, but if they stop making their payments, I can get my money back from the private mortgage insurance company. And so considering that with 20% down, you have no mortgage insurance, but with 15% down, you're required to pay mortgage insurance, your interest rate might be a little bit lower with the mortgage insurance, even though you're paying slightly less down.
Right.
So it's counterintuitive, and it still may not make sense because, mortgage insurance is not free, has to be paid either monthly or upfront. But the physical interest rate that you're going to see might be a little bit lower.
And the other thing to think about with that is your PMI is going to get paid off and removed at a certain point, but your interest rate, assuming you never refinance and you have a fixed rate loan, that's going to be forever, right?
That's a great point.
Until the whole loan is paid off. So
that's a great point.
So even if up front it kind of is a wash, which it may or may not be, you have to run the numbers, there will come a point where it is a gain.
Absolutely.
Yeah. Okay.
Yeah. To put numbers behind that, if you put 20% down, you don't need mortgage insurance. That's, if you think about the flip side of that, it means you're financing 80% of the purchase. If you put 15% down, you'll pay mortgage insurance for a little while, but only till the point where your loan is paid down to 80% of what you bought the home for, effectively the same as a 20% down payment. At that point, you can send a letter to your mortgage servicer. You have to do it manually. You can request that your mortgage insurance gets dropped off of your payment, assuming it's monthly. It would happen automatically if you continue to make payments and you get down to 78% of what you originally bought it for. If that's what you owe, it'll automatically come off. But you might want to watch how much you owe and calculate that for yourself. You can cancel a little bit earlier if you manually request it.
So I'm looking at the left-hand side, and it has the old range went from 620 to 740, right? Where anything below 620 was kind of the same, and everything above 740 was kind of the same. The new ranges start at 639 and goes up to 780. So now there is a meaningful difference between somebody at 740 and someone at 780.
Absolutely.
Am I reading that correctly?
Exactly right.
And when I'm looking at the top end of the loan to values, I'm seeing that there is a difference between the old way. The range seemed to have gone from 60% up to 97%, but the new way differentiates as low as 30% up to 95%. So both of those ranges have changed as well. All right?
Absolutely.
Interesting.
Yep. So talking about the different credit score ranges, if you're a 780 or above, as long as you put 25% or more down, you're getting top tier pricing. Whereas somebody that's slightly below that, they might need to put 30% down, or even more than that in order to get the top tier pricing. It's about the credit score, and if you don't have a 780, you're not the top tier anymore.
Yeah.
So that's the important takeaway.
So they're looking at the credit a little more closely than they used to, in a nutshell, right? And the better your credit, the better you're going to benefit.
Absolutely. So there's one other important point to bring up here about these changes is it's not just about the credit score is more heavily scrutinized. Generally before, the more you put down, the better the score you're going to get. Now it's a little bit different. If you're putting 5% down, you might get a better rate than if you're putting 15% down. Looking at it traditionally, like risk-based pricing, it doesn't make a ton of sense. And your mortgage insurance may be a little bit more expensive if you put 5% down. It's worth considering if you're going to get a lower rate, and maybe you'll pay down the loan after you close on the property. If you sell your old home and get a lump sum that you want to pay your loan down by.
The recast strategy.
Exactly. You can do a recast.
So what does that mean for people who don't understand?
You own a home and you're buying another one, and you're going to be selling the home that you currently own, but not until you buy the next one. Say, you qualify for both properties together, and you don't necessarily have to have the first one sold to buy the next one. So when you sell the first home, you're going to get a large lump sum payment from the equity that you have in the property. If you want to take that money and pay down your new mortgage on your new property, you would pay the loan off slightly faster because you owe a little bit less, but the payment's staying the same. Now, what a recast is, say you're more concerned with the monthly payment than you are concerned about how long you have left on the mortgage.
Yeah.
If that's your main concern, you could take that same lump sum, roll it into the mortgage, and perform something called a recast. So the recast means instead of that lump sum just shortening the term of your loan, they're going to leave the term the same and adjust the payment downwards such that it's still going to pay itself off in the same period of time.
It's kind of like any time anyone goes to buy a car, you can have a bigger payment in a shorter period of time, or you could have a smaller payment, but now you're looking at like 6 or 7 years instead of like 2 or 3.
Absolutely. Yeah. It's always a trade-off, and everyone has different pain points for whether their upfront expenses or their monthly expenses are more of a concern. So,
and again, the reason why we would do it in this order, where you would buy the house, then you would sell the other one, and then you would perform this recast, is because after checking the numbers, there are scenarios where you end up with a better rate this way.
Exactly right. So it's funny. Again, like I said, if you're getting a better rate with 5% down than you would with 15% down, you could theoretically pay the loan down after closing, get to the same equity position that you were planning to, but you end up with a better interest rate.
Yeah, and maybe a lower payment overall when all is said and done.
Potentially. The thing that you've got to watch is that mortgage insurance is not one and the same, and the mortgage insurance may be more expensive for like a 5% down situation than it would be for 15% down. So the rate's not the only thing that you want to factor in, but even with that consideration, it can still sometimes make sense. Do a smaller down payment at first and pay the loan down after.
So let's look at the next page on this list where you've got the different loan features. Talk to me about these, because this was really eye-opening for me. I didn't realize that having your debt-to-income ratio below a certain threshold could make this loan cheaper. I didn't realize that having a condo could make the loan more expensive. So tell me a little bit about what we're looking at here.
Absolutely. So there's more changes, not just regards to credit and down payment, but there's also, like you said, there's a new pricing adjustment for debt-to-income ratio, and that's your total debt, including this new mortgage, divided by your monthly income. That's what your debt-to-income ratio is. This is something that it used to not be a thing. It didn't have a factor into this rate in the same way. Now it's set up where if you can keep it below 40% of your monthly income, you're going to get a slightly better interest rate than if you were, running your total debt load over 40% of your monthly income.
Yeah.
So that's a big factor when you're just, you're calling different lenders and you're shopping for the best rate. It's not so easy to just say, hey, what's my rate? Like, what rate can you offer me? They have to dive into the numbers a little bit more deeply now to say, what is your debt-to-income ratio,
Putting that into perspective for that specific issue, the debt-to-income ratio, I almost want to call it penalty if you go too high on that ratio. So like, for example, Coleman, you ran some numbers for Elise and I when we were looking at 2 different properties. One of them was like at the top of our budget and the other one was significantly cheaper.
Yep.
If we chose to make a horizontal move into something cheaper rather than moving up into the more expensive one, I was able to keep our debt-to-income ratio below the 40% on this new acquisition, which means the loan is cheaper for me.
Exactly right.
In a nutshell, right? Whereas if I wanted to go to the top of my budget, now I not only am having a higher budget to begin with, but now there's also almost a penalty. I don't want to call it that, but it'll cost me more to get that loan.
Yep. The technical term for what you're describing is the loan level price adjustment. Or
loan level price adjustment.
Exactly.
There will be a price adjustment up.
Exactly.
if I try to stress my budget near its top.
Correct.
Yeah.
Correct.
Okay. And also, I've been investing in condos. Tell me, man, why is the condo more expensive? Why is there a price adjustment for purchasing a condo?
There's just slightly more concern in regards to, you're going to have a condo fee. And there's a condo association that has to meet, every so often and make decisions about, renovations, upkeep with the property. It's not entirely in the hands of just the homeowner, fixing their house the same way a single family home would be. There's more parties at play. But it's not a massive difference. It depends more on the down payment. It's something to factor in. Again, you can't just ask what's your rate. You got to see, is it a condo or is it a single family or townhome? Yeah,
because I do know that when you're looking at here, depending on how much money you're putting down, some of these the price doesn't adjust at all.
Right.
They just don't consider it an issue when you're putting enough skin in the game, right?
One other notable difference with the new pricing adjustments is we're now in a situation where pricing is the same between investment properties and second homes. So that was not the case before. And there's still minimum down payment requirements to consider with regards to a second home or investment property. But the vast majority of people these days, if you're buying a second home or investment property, are probably putting 20 to 25% down at a minimum, if not more than that. And with that, the pricing is the same between the two. It's not, I was
going to say, this only is for the price adjustment. Is there an interest rate difference for those two categories, do you think?
Interest rates and, the points that are being charged, they go hand in hand. So given the same rate, like what you're seeing on this graph is the difference in points. So all in all, yes, like the rates and points go hand in hand.
The reason I ask is, I've been led to believe that a second home loan is preferable to an investment loan if someone's going to try to get a property and it could fall into either category.
Yep.
Are we saying that it is no longer preferable? Are there no other advantage to the second home loan?
Like I said, there's down payment considerations. So with a second home, you can technically put 10% down and buy a second home, where you can't do that with an investment property. But again, like you can see the difference in pricing based on the down payment. It's heavily scrutinized on down payment when you're looking at these type of properties. So most people are doing at least 20 to 25% down. That's kind of what the pricing favors.
Oh, okay. So I'm seeing something on here that says high balance fixed rate. What's considered high balance?
So high balance means that's above the conforming loan limit. What the conforming loan limit is like the max conventional loan that you can get in the vast majority of the country.
Yeah.
Different parts of the country have different costs of living, right? And so we're located in Northern Virginia. We're technically called what they call a high cost of living area.
Yeah.
And because of that, you can get conventional loans above this conforming limit.
So they just adjust it. So that number of what is considered high balance is going to be different depending on the zip code you're in.
Correct. And I can tell you, the actual conforming loan limit, for the entire country is $726,200. Okay.
Gotcha.
Now, since in Northern Virginia we're high cost of living, that loan limit is actually $1,089,300.
So $1,089,000. Once you cross that threshold, now are you considered high balanced fixed rate?
High balance means that you're above the 726K
above
number,
the 726,
but you're below the million.
Oh, because that's the top of a conforming loan at all.
Yeah. At that point, it's time to start looking at jumbo loans.
Okay.
Yeah.
Okay. Oh, man, jumbo loans. I got so much to learn. Okay. I'm seeing another one, throwing you another curveball. What the heck is subordinate financing?
Subordinate financing would be like a second loan or a second lien.
Gotcha.
Yeah.
Okay.
Yeah. 80-10-10s.
Yeah.
Were a popular product in the past where you finance the first 80% with one loan and you have a second position loan covering another 10%, and then you only bring 10% down. So subordinate financing means there's a second position loan behind the first one.
And there's a price adjustment for being in subordinate position.
Correct.
Let's go to the next slide. What is this FHA monthly MI changes? What's going on here?
Yeah, so there's been some changes to the FHA mortgage insurance premiums that are paid. So it's important to realize with an FHA loan, there's two kinds of mortgage insurance that you're actually paying, right? There's an upfront mortgage insurance premium and a monthly mortgage insurance premium. Okay. With conventional loans, you could have monthly or upfront or a combination of the two. But with every FHA loan, you're going to have both. Now, the upfront mortgage insurance premium, that's not changing from where it was before. It's 1.75% is the upfront mortgage insurance premium for FHA. That gets financed into the loan. You're not paying that out of pocket, but it's a real expense that you should consider when you're buying a home. It's just financed. It's not paid out of pocket. The monthly portion of it gets paid on a monthly basis. It used to be, for the most common FHA mortgage product, which is going to be your 3.5% down FHA loan, and we'll say that the majority of them are below that 726K number we talked about earlier. For that person, their monthly mortgage insurance premium used to be 85 basis points, or 85% of 1% of your loan amount, divided into a monthly basis. That's going from 85 down to 55. I'd say that's the most common FHA loan, and that's the change that you're seeing. So that can mean a significant difference. Like I've got a loan locked in right now that we had planned on needing them to pay 85 basis points of monthly mortgage insurance, but they made this change, and I was able to call them back and say, hey, good news, your payment's going to be $86 a month cheaper than we had planned on. It's gone down to 55 basis points. But the reason why I wanted to bring this up is because On one hand, you've got conventional loans being more heavily scrutinized based off of credit. And on the other hand, you've got FHA loans, which are usually more advantageous for lower credit. Someone who might not be able to qualify for conventional. That's getting cheaper. With those two things combined, there's a specific buyer out there that before a conventional loan would have been a no-brainer. Now, an FHA loan is a real contender that they should consider.
Yeah.
Yeah.
So let's look at that then. FHA versus conventional. How do I know which one's going to be right for me, given these changes?
Yep. The right answer is that you should talk to your local mortgage lender.
Of course. But what do these changes mean? How has it affected the comparison?
I'm going to speak in generalities, but before, if you have a credit score over 700, vast majority of the time, a conventional loan is going to be, a better option for you. You can do it with just monthly mortgage insurance that'll a lot of times be cheaper than the FHA mortgage insurance and completely ignore that upfront premium that the FHA always requires. We talked about once the loan's paid down to 80% loan to value, you can cancel the monthly mortgage insurance.
Yeah.
So the difference in mortgage insurance was usually the reason why the conventional loan would be more advantageous than FHA. But now, since the monthly mortgage insurance is getting cheaper FHA and credit's more heavily scrutinized
on the conventional.
Exactly, on conventional. People that are in like a 700 to 720 credit score range.
Yeah.
I'm actually finding that FHA you might be cheaper out of pocket and monthly.
Wow.
Yeah.
Wow.
Yeah.
So those people who used to be thinking, hey, conventional is the automatic choice, make sure you check with your lender because there's a lot of you out there who may find FHA to be a better deal right now.
Absolutely right. Yeah.
And now let's also put the caveat on there for those of you who are not clear. FHA needs to be owner-occupant, right?
It does. It does. Yep. So what we're opening up now is basically an illustration to that point. We're going to assume a couple things. We're going to assume that their credit score is between 700 and 720. We're going to assume that their debt-to-income ratio is over 40%, so you're getting hit with that adjustment we talked about. For that credit score range, you're going to see a massive difference in the interest rate between an FHA or conventional loan.
Wow.
From here, we're literally looking at 5.99 or about 6% to over 7%, mid sevens. I'm illustrating a situation here at a $750,000 loan amount, which would put your loan below the 726K number. So you get the cheaper monthly mortgage insurance. But with this, in this particular situation, if you're comparing FHA to conventional, the conventional total out-of-pocket expenses with down payment and closing costs will be in the ballpark of $65K, where the FHA is going to be in the ballpark of $45K.
Yeah,
payment.
That's $20,000 cheaper up front, and then how much a month?
Over $500.
Over $500
almost
a month.
$600.
So that's a significant difference that if you're not paying attention, you could miss out on, right? You just go to one of these online lenders not realizing that you're talking to a machine when you really need to be talking to a thinking human who can guide you on this.
Correct,
right?
correct.
I mean, you make that mistake, it's going to cost you $20,000 up front potentially. It's $500 a month potentially. That's a huge difference.
Yeah, yeah. And it's also important to realize that this situation assumes a 5% down payment. This more than likely would be a repeat home buyer.
Yeah, that's a really I mentioned earlier, that's a common one that I see all the time.
Yeah.
Is 5% down people.
Absolutely. Technically, if you're a first-time home buyer, you can do 3% down. The out-of-pocket expense cash to close, would be a little bit different for somebody that's only putting 3% down. But the monthly difference would be even further exacerbated in that situation.
Yeah.
So it's worth considering.
In this example, was the FHA also putting the same amount down, or I know it looks different?
No. So in this one, the FHA has the minimum 3.5% down. Conventional has 5% down, which would be the minimum.
It would be the minimum for the typical conventional.
For the typical repeat home buyer
Yeah.
using a conventional loan.
Yeah.
Most of the time. There's caveats to everything. There's certain, if you're below certain income thresholds, you can put 3% down on a repeat purchase. But there's a lot to think about.
There's always a lot to think about. You're not just lenders cannot be, let me say this into the microphone. Your lender cannot be easily replaced with some internet website. Okay, they have a full-time job that takes serious man hours in order to figure out the best way to save you money.
Absolutely.
It's got to be one of the. What are some of the most annoying things privately that lenders probably joke about to each other? Is it the "What's your best rate" question?
That's exactly what I was gonna say. It's shopping for an interest rate. It's just more. It's more. There's more than meets the eye to it. You might be looking around and you're just, okay, I want the best rate. I want the lowest number for my interest rate. So you shop X, Y, Z lender. One lender's at 7%. One lender's at 6.5%. One lender's, at 6%, and you're like, oh, obviously I want to go with the 6% guy. But then you realize that the reason why he's offering 6% is because he's charging you a boatload of upfront points and fees. Mm-hmm. And there's some lenders that they'll state maybe 6.5% for no points. But then you look at their fees and realize that their fees are really expensive, and that's how they're able to offer the lower rate.
Yeah, correct me if I'm wrong, but I thought of an analogy. Imagine you were going to 3 tailors and you were asking them to, give me your best suit. Mm. All 3 of them have a suit already made, and they don't know your measurements yet. Mm-hmm. You need to take into account the specific circumstances of the person who's asking for the rate, right?
Exactly.
The whole point is that they're going to tailor the suit to fit you. And if they're not doing that, then whatever they're quoting you is irrelevant because it's not going to fit you.
Exactly. One tailor's best suit might be the cream of the crop, but he's charging you, $5,000 for it or something, and then
it'll look terrible on you.
Yeah,
right.
Yeah,
it'll be a total mismatch.
Yeah.
Their best suit that the tailor ever made might be for, a 7-foot tall man, and you happen to be a 5-foot tall woman, and that's not going to fly.
Yeah, yeah.
Right? It's going to be mismatched, right? Mm-hmm. It's not going to be appropriate. Same thing with these rates. There's so much that goes into finding out what is actually possible for you, and a lot of times you look online. They haven't even asked you for any of your personal information yet, and yet they're quoting you something. Yeah. Well, we know right away that quote has nothing to do with what you could actually get.
Mm-hmm. That's accurate. I just want to briefly touch on, there's also been changes to the VA loans, and it's typically, the big changes with the funding fee. So what a funding fee is, for those that may not know, you can think of it as the equivalent of what mortgage insurance would accomplish for a conventional loan, right? So It's not exactly the same. It's financed upfront, similar to the FHA upfront premium. It's most commonly financed, and the first time you use it, if you're a veteran and it's your first time use of the VA loan benefit, 2.3% was the old number. So say you're buying like $100,000 property, just to make numbers easy, your loan amount, if you're financing everything, is going to be $102,300.
Right.
So that 2.3% funding fee has been reduced to 2.15. So your first time use, instead of it costing 2.3% financed up front, it's now 2.15. So it's a marginal savings, but it is legitimate.
Yeah.
Note that not every veteran needs to pay the funding fee. There's a lot of people out there that this doesn't even apply to because they're exempt from having to pay the funding fee.
Gotcha. So
always check. You want to have a lender that's going to check your eligibility and see whether or not you're required to pay that.
So I remember from the meeting you mentioned something about a grant program.
Absolutely. So Atlantic Coast Mortgage is able to offer this grant program right through the Federal Home Loan Bank, or FHLB. A lot of independent mortgage companies out there, the vast majority of them, are not able to offer this. This is something where the FHLB is like a system of banks that's offering this grant, and the only reason ACM, Atlantic Coast Mortgage, can is because we're partially owned by one of the banks that's within that Federal Home Loan Bank system. And so what the grant really is, there's 2 different versions of it. One is specifically just for first-time home buyers. So if you're a first-time home buyer and you're below certain income limits, we can offer $12,500 as a grant to you, and you can apply that towards your closing costs and or your down payment.
Nice. That's really good.
Absolutely.
That's some serious money.
It is.
I mean, depending on the price point you're looking in, that could basically pay for everything out of pocket that you would have needed.
Almost everything. You're required to at least bring $1,000 to closing net. But beyond that,
still though, $1,000 to buy a house.
Exactly. Like, for example,
oh my God, you'll make more than that just from appreciation in the first year.
Absolutely. I mean, for example, I have a client right now where their closing costs were negotiated into the contract to be paid for.
Yep.
And their down payment was less than the grant would cover.
Yeah.
And so they're trying to figure out what to do with the excess grant money. And
are they able to just have a larger down payment?
Exactly. So they get it's a great problem to have. Like, how do I spend this money? You can either just have a larger down payment, which will make your loan amount lower and your payment slightly lower, or if you wanted to, instead of doing that, use the money
buy
to
down the rate.
buy it down the rate with discount points like earlier,
Yeah.
the monthly payment difference is going to be more significant.
That way. Yeah,
Yeah.
for sure. Okay. That's awesome, dude. So one more time as a quick recap, some of the major changes include credit score, more scrutinized now. FHA, if you weren't paying attention to it before, pay attention to it now because there's a good chance that it may be better than conventional depending upon your unique circumstances. Talk to your lender. VA funding fee has been a little bit reduced. And the fourth one was the grant program, which sounds amazing for some of those first-time home buyers especially.
Great for first-time home buyers. You get the $12,500 grant. It's also, there's another program for community partners. So if you happen to be a school teacher, in law enforcement, a lot of different medical professionals, they'll fall into this category where instead of $12,500, it's $15,000. So it's even just a little bit more money.
Yeah.
Again, there's income limits, and the income limits are going to vary based off of the size of your household and the actual geographic area that you're looking at. But it's a great program for those that qualify.
And it's not limited by state or anything like that. It's good for all 50 states.
Correct.
Awesome.
Absolutely.
So how can someone get in touch with you to learn more about these changes, these grant programs, find out what's right for them so they too can save potentially a ton of money up front and a really sizable chunk in the payment?
Yeah, so if someone wants to send me an email, my email address is cbales, that's Bales, at acmllc.com. That's my email address. If you shoot me an email, I'm very quick with responding. If you want to get in contact with me on Facebook, I've got a business page. You can just look up Coleman Chadwick Bales, and that should come up.
All right, you guys. Well, Coleman, thank you so much for coming in today. I look forward to having you on yet another one in the future.
Absolutely. Thanks for having me.
Everyone online, thank you so much. Have a great day.
Have a great day.